Bitcoin and cryptocurrency investing. Tax and legal implications. Investing in Bitcoin and other cryptocurrencies has evolved from a niche hobby into a complex financial endeavor with significant tax and legal responsibilities. As crypto takes an ever larger position in global commerce, regulatory bodies like the U.S. Internal Revenue Service, IRS, and its global counterparts have established clear frameworks that treat digital assets as property rather than traditional currency. This means that every transaction, whether selling for profit, swapping one coin for another, or using crypto to buy a coffee, is potentially a taxable event that requires meticulous record-keeping. The primary tax implication for most investors is the classification of cryptocurrency as a capital asset, making it subject to capital gains tax. When you sell or dispose of an asset for more than its purchase price, your cost basis, you trigger a taxable gain. In many jurisdictions, including the United States, these are split into short-term gains, held for 1 year or less, and long-term gains, held for over a year, with the latter usually benefiting from preferential, lower tax rates. Conversely, if your investment loses value, you can often use those capital losses to offset other gains, a strategy known as tax loss harvesting, though strict rules govern how and when these losses can be applied. Beyond simple trading, earning cryptocurrency through activities like mining, staking, or receiving airdrops is typically treated as ordinary income. The fair market value of the tokens at the exact moment you receive dominion and control over them must be reported as gross income for that tax year. This creates a dual taxation scenario: you pay income tax upon receipt, and then if the tokens increase in value before you eventually sell them, you will owe capital gains tax on that subsequent appreciation. Failure to report these microearnings can lead to significant penalties, as modern tax authorities now use sophisticated blockchain analytics and data sharing from exchanges to track non-compliance. Legally, the landscape is shifting toward increased oversight and know-your-customer requirements to combat money laundering and fraud. In 2026, most major exchanges are required to issue automated tax forms, such as IRS Form 1099-DA in the U.S., to both the investor and the government, effectively ending the era of anonymous trading. Furthermore, the legal status of certain assets, specifically whether they are classified as securities or commodities, continues to influence which regulatory bodies have jurisdiction over them. Investors must remain vigilant, as these legal classifications affect not only their tax filings but also the types of platforms and products they can legally access in their specific region. We welcome you to subscribe to our YouTube channel for more informative videos on cryptocurrency, investing and taxes. Thank you.